the question many traders actually ask for me, and many investors for that matter, is institutional trading actually relatable to retail trading? Because when we are thinking about institutional trading, we think they are living in a completely different world with their opportunities, with their resources and everything in that matter. An answer to that actually, I believe, is like 50-50, because there are types of trading and approaches to market which is completely irrelevant to retail investors, which is algorithmic trading, which is statistic arbitrage, and which is market making and prime brokerage for institutional traders. If you look, like, I don't know, movies, how largest banks trade, they are pushing like billions of dollars worth of deals on behalf of pension funds, or they are trading from their own proprietary trading desks. That sort of trading is not relatable to retail traders, because they are actually executing money on behalf of their bank or their large customers, and they are making money out of bid-ask spread. And this is more comparable to early day physical pit trading, where simply brokers were connectors between buyers and sellers and made some sort of small price difference within those transactions, and they have like fixed way how they made money day to day if they didn't gamble with that. So this is one approach. Other approach is something like most hedge funds, I would say, do, and particularly I would say these are CTAs, or commodity trading advisories, and global macro traders. In this way, they are making effectively bets how markets are going to move regardless of political, I would say, events or supply and demand, and basic approach of fundamental and technical analysis. Here also I could add long-short market neutral hedge funds and probably specific stock picking strategies within hedge fund realm. But I wouldn't talk about them in this discussion. My emphasis is on macro trading, because I believe this is the most relatable to retail traders. And here I believe we have direct comparison between retail trading and actual macro trading from hedge funds. Because here's the fact: if someone trades specific stock as a hedge fund or mutual fund and retail trader, probably hedge funds have some sort of edge in the fact that they probably will have larger positions, and they might have some voting power within those companies, or at least they might have some price advantages when they are buying or selling large blocks of shares. For retail traders, they are simply buying retail prices which they get. If you are talking about stock indices, bonds or bond futures, commodities, cryptocurrencies, on other macro products, effectively most of the hedge funds don't have any edge. Or if you are looking at euro against dollar or S&P 500, none of the persons involved, none of the parties involved in these trades actually have some edges. Maybe these are large traders which are providing liquidity for markets, which are setting like Libor trades and market making for euro and other largest currencies, but these are also more market makers than positional traders. But from positional trading standpoint, they don't have any advantages against retail brokers, and this is the fact. They actually have almost the same availability to information and same decision-making process. So if you are actually looking at macro hedge fund and yourself, you are kind of in the same position. And then I would say, yes, you could actually directly relate to them, because if you are looking at most successful hedge fund managers from global macro trading perspective, they have really similar principles as with many traders, because they actually have disclosed their strategies and their philosophies in many interviews and in many books. Just read books of Jack Schwager, where he covered most successful traders and hedge fund managers in his legendary book series. Just look at these interviews these traders and hedge fund managers are making, and you could see this is really applicable, and really you could take much of that. And the key characteristics, of course, is that no one is actually betting on what market is doing. And if they are betting at what market is doing in next 6 or 12 months, they are not counting on it. They are just simply evaluating possibilities. So that they think in terms of what are the possibilities that if something happens, S&P 500 or gold will rise or fall. And then if something happens, they are seeing like we have 10% of chance that S&P 500 might rise 30%, or we have 10% chance that S&P 500 might fall for 50%. And that if some event happens which could trigger that, they have specific trades which would anticipate this move, and they will make money. They are certainly not glued to one specific trade or idea, and then they are doing everything they can to justify their positions. So They are thinking in probabilities, what happens if, and if something that might happen, they have a strategy when they are preparing for that. And once something like that happens, they are using very strict risk management tools to maximize that profit opportunity. And if things go sour, which happens most of the time, they have extremely strict risk management tools that limits exposure from their traders and their hedge funds, so they lose very few amounts of money if they are wrong. And that's like nutshell of trading: cut your losses and let your profits run. And every single strategist from every bank or hedge fund will tell you that analysis is like 10% of process. 90% of process is ability to manage risk, cut your losses, and maximize your profit. And this is like trading 101 that most of the traders still don't understand, that you have to put your 90% of your effort to understand how you could minimize your losses and maximize your profits. And do not think about scenarios what markets can do, because there is the one thing you could actually do. The only thing you can do is limit your losses and understand how much you are going to lose. You have no influence over the markets, thus you don't have influence on how much you can make. But you have influence over your actions and understand how to correctly put risk management tools and limit your losses. That's the thing. For instance, many traders start with crypto trading. They think that Bitcoin should go to, I don't know, 150,000 or 1 million, but they don't have control over that. They believe they have because they read a lot of research and follow the influencers which say the same thing, but that's not going to impact crypto markets in any way. So they don't have to think about those cherry scenarios. They have to think about possibility if everything goes wrong, how much they are going to risk. And if they understand that if everything goes completely wrong, worst case scenario is that they might lose like 5% out of their capital. And if things go really sour, they could short the market and actually make money out of the market fall. That's thinking that real traders have to understand and learn from professionals, that they are able to understand that they are wrong very quickly, limit their losses, they don't care about their long-term beliefs in terms of market actions, and they quickly can reverse themselves. I think there was a saying that good traders limit their losses, great traders reverse. So that means if you have anticipation that Bitcoin might double in price, so you are starting to build your positions, but then something bad happens, markets are going to your previous position and you are showing loss, you have to have risk management tools that would limit your losing positions. So ideally you are closed out automatically with small losses, and if you see something goes bad, you could actually short the market. That's your approach. And you don't care what your crypto influencer thinks, what you have to like or don't like about Bitcoin regulators and everything like that, because that's out of your control. Only correct thing in markets is price, and every professional will also tell you that markets are never wrong, opinions are wrong, but markets will always tell you the best price, even if you don't agree with that. Me myself, I've been wrong hundreds of times, and I haven't agreed to market participants, regulators, central banks and whatnot, but they don't care whether they exist or not. So my goal is to be flexible and just to follow the trends. And here's the main takeaway for this video. If you want to be a professional trader, look how macro traders trade and understand the thing that only strategy that has survived through decades or even centuries has been trend following. And if you understand trend following, you might have huge edge in the markets, and based on trend following philosophy, you might actually build pretty great strategy. So understand trend following and basic principles of trend following. And I will continue to talk about trend following, and I will give you basic principles how you can actually make money regardless whether they are rising and falling. And this is the key thing for traders. You are making money regardless of what happens in markets because you follow the trends and you are protecting your money with best risk management tools.